Good afternoon, everybody. Welcome to our Trading Index Options webcast. I'm Connie Hill. Happy you would join me here today. You know, we've been talking about building some different, I'm going to call them system rules, which are basically just guidelines we're going to follow as we're trading SPX options. And there can be lots of different guidelines that you might choose to trade. A couple of weeks ago, we started building a new system that I called the linear regression model. We got into it partway, but we did not finish it. So we're going to finish out that rule structure today. We're going to go back and look at some of the SPX option trades that have taken place over the last few weeks, including the last couple of weeks. And we'll see where we go from there. I hope also to resolve a couple of concerns that came in on the last survey. Fantastic comments that some of you wrote in about, so I want to cover those as well. So got a pretty full agenda that we're looking at right now. Now, I am joined in the chat by Barb Armstrong. I'm so glad Barb's here. Great veteran of the market, great friend. You guys all know Barb, right? She's here to help me answer maybe some questions I can't quite get to, although I realize some of them are going to be directed at me. I'll keep my eye on the chat. Barb will be there as well. If you're listening to this on the recording, and when you have questions, go ahead and write it in the comment section in YouTube. Because I go back, I look at those every day. Make sure that you get your questions answered as well. Let's go through our disclosures and get into our agenda here today. The information we talk about is for general informational and educational purposes. Don't consider a recommendation. Past performance is no guarantee of future results. American style short options can be assigned at any time up to expiration, regardless of the in-the-money amount. Primarily, we are not going to work with American style index options. We're going to be working with European style index options. One of the great advantages they have is they do not assign early or run the risk of being assigned early like an American short option could be. We'll be using the Paper Money software application. It's for educational purposes. I think it's a fantastic tool as you're maybe trying out new strategies or rules on strategies. Test it out in your paper account. In the paper account, one other difference is that it will not assign short options early. Not as big of a factor in this class if we're trading those European style index options, but it is something that you should know about Paper Money. Okay, lots of it is great, but it's not a perfect mimicking of the live software in all instances. All right, well, let's do this. I first want to bring your attention to some upcoming events. And several of you, I think several of you made the Chicago event last weekend, had a great time. I saw some different comments people made in the chat. But next week, August 1st, Dallas Market Drive event, that'll be just on a Saturday, one-day event. Next week, Orlando, August 7th and 8th, that'll be technical analysis and option strategies. And then a New York event will be the advanced options, August 28th and 29th in the New York Marriott Marquis. Now, if you're interested in signing up for any of these classes, what I'm going to encourage you to do, go log into your Schwab account, come over here to Schwab Coaching, and then scroll down here to where it says in-person events, right? That's where these events are. View the calendar. You're going to see even beyond what I just highlighted here because we're going out to the end of the year. And if there are any of these that you want to sign up for, do it early, okay? Click on the Learn More, and then you can walk through the registration process, okay? If you need to cancel it later, not a big deal, but if you really want to go speak for your seat right now, okay? That is enough for those items right now. Okay, next up, we are going to go back and tackle our rules with using SPX index options. And I'm going to take us over to this slide here. Well, what the heck is on this slide here? Let's show you. We introduced you to maybe a different set of rules, okay? We had our original index option rules, and then we did some modification to that using the market forecast study using specifically the blue line. And then somebody said, I'd like to experiment with some additional rules. I think linear regression might be interesting to tackle. One of you in the survey, and I want to give you credit for this, I don't know who it was, said, if maybe we could also use the whole 10 and 20 moving average. So if you follow along with James Boyd and you're familiar with those moving averages and how they work, what they're intended for, you absolutely could experiment in your paper account, say, well, would this work with index options too? Okay. So I would say any rule structure that you can think of, test it out, make sure it looks like it's going to work. Now, it's probably not going to work in every single scenario, even if you test a lot of different ones, because markets can do strange things. They can be erratic once in a while. And so you just want to make sure you can kind of test for that and get an idea. All right. Let's do this. Let's explain what we're looking at here. I'm going to go to the studies because I don't expect that you probably memorized all of this. Maybe you did. We've got some super smart people in here, but I don't expect you to have memorized everything. What we did on our studies here, I've got a 6-month chart, and I started bringing up linear, oops, I'm missing a letter, huh? All right, linear. And we put on here a couple of different things. We put on the linear regression trend line first, and then we put in linear regression 50 and linear regression 100. Okay, and it plotted what we're seeing over here. And so keep in mind that this middle line here, maybe I'll do a little drawing here. It represents basically the mean. And the mean basically says, I'm going to go and see where I can draw a line where I can hit as many candles as possible. Okay, because that would be the mean price of, in this case, the SPX that we're looking at here. Then the 50, linear regression 50, basically goes 50, well, we did 100 first. 100 is this red line out here, and it represents a couple of things. One, it represents the furthest area away from the mean. And it so happens that right there on that day was the very furthest point in the 6 months of data that we're looking at here. You want to stay consistent with the time frame that you're looking at, meaning I've got it on a 6-month chart, so it's going to pick either the highest point or the lowest point on that 6-month chart. If you feel like you want to do something a little bit longer time frame, you could pick a year. Your low point wouldn't necessarily be here. Okay, it might be, but it might not be, or the highest point. Okay, maybe 6 months earlier, encompassing a whole year, maybe it would have been in some different areas. In any case, the 100 picks this furthest from the mean, and then on the opposite side, in this case, the top, it plots the same amount away, meaning the plot, the plotting of this line is, let's call that X. Well, it'll go and plot X so that it's equidistant away from the mean, exactly however much this was. And we'll notice here in the 6 months, gee, it didn't ever get up that high, right? It did not ever come up and hit anything up here. So we just kind of want to recognize that. Then the 50, linear regression 50, basically is this midpoint. Okay, let me maybe erase all these, go back. So this green line here and here basically represents half of what this whole width is. Okay, so half there and half up to there. And one thing that we'll notice about this is that prices tend to hit an extreme and then revert back to the mean. Okay, they don't necessarily go there instantly. Okay, but many times we'll see this might be a support area. This green line here, sometimes that 50 line could be a support area. This mean line here could be support, could be resistance too. Okay, so each of these lines could be acting as a form of resistance or support. And so we want to recognize it for that. So that's the basic construction here. So we know what the chart is now. Let me kind of clean that up a little bit. Let's see what Mark is saying here. Oh, okay. Mark's making a comment here. He said he did some back testing using the on-demand. And he said it's going well. He is doing Mike Fairborn's modified super trend indicator. Is still beating the market forecast based on trading rules. Looking forward to the linear regression rules. So, Mark, I appreciate what you're doing there as far as looking at what can be used, because we can use a ton of things, right? So we're trying to make it simple to the point that it's easy to repeat, right? Process the rule, and so forth every day, versus having a lot of subjectivity in it. Okay, we're trying to do something like that. I'm interested in knowing how your super trend indicator is working out. If you want to share any of that information out on X, I'd be happy to take a look at that with you and maybe make some comments in our class. All right. So let's talk about the rules. We have the setup. We know what the chart looks like and what it represents. And let me put in here a couple of rules. Overall, this trend is bullish. And if we look at multi-year trends of the SPX, even if I go out here, say 10 years, we're not going to take a scrud. I accidentally picked an hour. That's not what I wanted. I was going to come out here to about 10 years. Overall, the trend is fairly bullish. And so the assumption here is that we're likely going to take a bullish trade unless there's a reason to take a bearish trade, or it makes more sense to do a bearish trade. Okay, but overall, our bias is going to be bullish. Now, we're not going out 10 years. I do want to point out here, notice how the highest point away in the 10-year period is up here just recently when the SPX put in another all-time high. That date was the week of June 1st. Okay. So the 6 months we're working with, the time frame, that extreme point was down here at the bottom. Okay. Next up, rule number 1 says we're going to take a 6-month time frame. If you want to use a different time frame, you can, obviously. We're going to just be consistent right now with using 6 months. And let me kind of copy this over here to our notes. And let me make it bold and spread it out here a little bit. We'll put 1 and 2. All right. So LR stands for linear regression. Lines are up in the bullish time frame. If that's what they're doing, then we're going to take bullish trades. And this is what we're looking for. We could take a trade any day that the market's open. Okay. And we're going to take a bullish position unless we see bearish signals. Well, what constitutes a bearish signal? A bounce down off of either the linear regression mean line, which is this kind of grayish, I don't know if you can see, it's kind of gray, all right? Or maybe it is bouncing down off of the 50 line, or even possibly the full 100% line, okay? It doesn't get up in this territory very often right now, okay, the way that it's been trending. And so we might consider bearishness when we see doing a bearish trade, if indeed it looks bearish enough to take one. The other thing we can use here is we can use, if there's a bounce down off of any of those lines, the 50% line or the mean line, plus a bearish candle that is bouncing down. Okay, so if we maybe think that it's bouncing here, but it's a bullish candle, then we wouldn't take it. We want to make sure and see it as a bearish candle. That would mean, okay, let's take a bearish trade as opposed to a bullish trade. Okay, so today's kind of this is a good point to talk about today, because we have all these days, the last couple of weeks since we've been together, that it's kind of hovering around that mean line, isn't it? Let's, we're just going to kind of zoom in here a little bit. So there could have been days here where it looked like maybe it was bouncing down off this line and it was looking maybe a little bit more bearish. I would say it would need to have a decent sized bearish candle as opposed to, say, a spinning top or a doji, right? Spinning top doesn't have much of a body, but does have a little body. A doji, usually the opening and closing price are the same price, and so we don't get much body there. We just kind of get a little line. Okay, so these two, even though they're bearish candles, the body's not that impressive for me to go, whoa, bearishness. Okay, for example, here at this mean line, we have 3 days of some bearish candles, and then this one looks like, yeah, it looks like it's bouncing off of that mean line, and it is a sizable bearish candle. So somebody might have considered possibly going bearish on that candle signal. In this case, it actually didn't work out so well, did it? No, it did not work out so well. It went opposite direction. And then it doesn't go up here all the way to where we could see potential resistance, but it does roll over there. Okay, today, would it qualify for an entry here today? Well, the assumption is we're going to take a bullish trade unless it looks bearish. Okay, so today, does it look bearish? Okay, does it look like it's bouncing down off the mean or off of the 50% line? Does it look like it has a bearish candle? And it doesn't actually have any of those. Okay, so the answer would be we would take a bullish trade here today. Now, how far out are we going to go? Let's put on some additional rules here. We are going to sell 14 days out, 14 days to options expiration. So this probably, hopefully that'll copy over as 3. Let's go back here. This is kind of point 3 is we're going to sell a 17 or 18 delta. We're going to go 14 days out to options expiration. So we might have a few days in the trade before maybe it hits an exit point, all right? Then let's put in our exit rules here. Exit rules we did not spend a great deal of time on, okay? This is where some of this information is going to be a little bit newer, okay? I actually don't remember if I mentioned it a little bit or not. All right, so this will be point 4. Exit rules. We're going to get out if we hit one of a couple of things. One, we make 50% of our target premium. Okay, if we bring in $2 and the price of the spread dwindles down so that we could go buy it back for $1, that would be 50%. We'd take it and get out. We're going to put that order in right when we get into the trade. Okay, so we're going to do it immediately. This next point here, we're going to have to do some testing, do some modeling, and see how well we like it. Okay, I have not done a lot of testing with it yet. When we're working, let's go find what spread we might work with today. We go 14 days out, and we've got 120 strike prices here, and we're saying the first 17 or 18 delta, so we might have a couple of choices. Here's our delta column, 14 days out. We have a few choices here. Here's 17, 17, couple of 18s. So therefore, we have some choices here. We are likely to pick the one that has a lot of open interest, and then we're going to spread it out $20. So for example, suppose we were going to sell the 7,300, then would put in 72.80, that would be the hedge leg on the spread. Okay, we'd be doing a credit spread, basically a short put vertical. Some of you might call it that. One thing I want to talk about here is I want to talk about, I'm going to change this column here to be probability OTM. And this addresses a concern that one of you wrote in about, and that were some great comments on it. And the concern was that we're risking a lot more than what we have to gain in some of these SPX trades. So let's go ahead, let's put this one together. We'll sell the 7,300 and then we will buy the 72.80. So we'll say sell vertical, and we'll come in here and we'll change this strike price. Let's see, we started out at 7,300, right? So it just went and picked the next one. It doesn't know how far out we want to do things. We want to change that to 72.80. There we go. And the credit right now would be about $2.40. Well, what's the probability that that option, that short leg, that 7,300 would expire out of the money? It's about 80%. And we're trying to do something that is higher probability. Now, is it guaranteed that it will do that? No. Is it guaranteed that it will expire out of the money 8 times out of 10 because it's an 80? No. Okay, it's just how the probabilities are right now at the moment. But what's our risk? And we're going to use this over here. If $20 is our spread and we are bringing in a credit, I'm just going to lock this up at 250. Okay, we'll lock it up at 250. Makes our math really easy. Then we are risking what? We're risking 1750 to make 250. Somebody that commented ran some numbers and they're like, oh, that kind of scares me. I don't think you used the word scared. It was concerning, right? And so it might be wise, because there is so much at risk, 1750, that maybe we want to consider putting in a stop here as well. And we get to decide how tight or how wide the spread is that or the leeway that we want to give it. So for example, if you wanted, if it were getting in for 250, if you were feeling like I'd let it go against me 250 or 1 times, then we might build that in and say, okay, if it goes against me 250, let's get out of the trade. What if it goes against you 2 times that credit? Then maybe would say, okay, if it goes against us at $5, then we get out at that point. So that's where I'm saying we're going to have to work with some rules here, kind of massage them a little bit, see what works. If we were to do something like putting on the stop really tight and saying, for example, if the value of the spread got up to $3, which is just 50 cents away, get us out. We'd probably be getting out a lot, right? It would be too tight that it would really trigger it. And so the key is determining how much leeway you might want to give. Okay, so I'm going to suggest here to begin with. Doesn't mean everybody would be comfortable with this. If you want to try different things, do different things, okay? I was going to suggest maybe for this practice trade we're going to do today that we put on a stop that's 3 times the value of this spread, meaning that it would take out the credit, it would wipe that out and then go against us 2 more times. So basically we'd be looking there at 750, right? 3 times 250 would be 750, having it go against us. Does that make sense? Hopefully that makes sense. And we're going to build this in when we put the trade in. Okay, so we're saying it's not giving us big bearishness, so we're going to go bullish because that's our rule. We're assuming a bullish trade unless there's evidence to suggest not to. Now, I went through a lot of information here, so I want to kind of come back to some of your comments and questions, make sure we're getting them answered here. Interesting comment here from, I'm going to call you 082000 SM. Said, I bet Alphabet and Tesla earnings would move the SPX quite a bit. Yeah, they very well could. And especially in earnings season, we have, it's the season when the news comes out, and it makes stocks move in a big way. And some of those heavy hitters, some of those Mag 7s that were basically a pretty decent majority of the market. Yes, when their earnings come out, like Google, Tesla, yeah, absolutely, they can be a big factor there. Yeah, we'll find out. Google will be announcing their earnings this afternoon. Mark's just sharing some information, which is good. Chris says the green line is halfway between the mean and the red line, so I can't see how that's particularly meaningful. It adjusts only when the red line adjusts, or am I missing something? Let's go back to the charts here, Chris. Good question. Right now in our time frame, it isn't very relevant. Okay, we're looking at 6 months here. Let me kind of back out, make sure we've got the full 6 months. So in the time frame in our 6 months, primarily it's been bullish, right? And so you're right, it kind of at one point looks like before this extreme point ran up to the green line there, then really pulled back to the full extreme line. And in this period of time, we're not seeing it hit it that often, right? We're just seeing maybe it run up to here, maybe run up to it here a second time. And so there may be periods of time when it's really relevant and other periods of time when it's not. Okay. So good observation in our time period. Now, suppose we used, we'll just look at this real quick, 2 years daily, and I'm just guessing to put in more time frame here. It could have been that it became more relevant, but the low line, instead of being here, like the time frame we're looking at, the low point is clear over here around April 10th, whatever that week was, something in that range. Okay. All right. You know, as we play with this model, you know, we'll have to see what the track record shows. And we'll also have to see, is that stop, we do three times the credit, does that give us enough buffer that we feel comfortable with? Or is that too much? Is that too much leeway? Okay, we're not going to know until we try it out a little bit. All right, so let's go ahead. Let's put on the first order for today. We had queued up that 7,300, 7,280. We're just going to do one contract here. We're going to bring in a credit. Let's see what it's running right now. Ooh, 240. Longer we go, the higher it gets, which must be dropping a little bit. Puts are getting more valuable. And we're going to put in a first triggers OCO. So after this order goes in, we're going to put on our exit order, one for profit, one for loss. So we'll create 2 opposite orders here. Let's configure this first one to be, if we get a good chunk of this, which we've been saying in our rules is about 50%. If we hit 50% of the target or so, we're going to get out. So if this gets down to the spread being worth 120, great. We're saying thank you very much. We're out of here. If it still looks bullish, we'll put on another trade. There's no constricting rules that says you can't put on multiple trades one after the other. Okay, we're going to leave that open because if it's working, man, we're going to like rinse, repeat, do it again. Now, this is our part here if this trade were to go against us, right? Was it 250? Maybe we should still try to get 250. So if this goes against us, wipes out the 250, gets to $5 and then 750, because that would be 3 times our credit. then in that case, we're saying we want to get out. We don't want to wait till we get half our max loss or a huge percentage of our max loss, because we already said our max loss theoretically here is about 1750. So we're trying to limit it without choking the trade. So we're going to say, or if it gets up here to 750, and we're going to have to put this on as a stop, which means trigger a market order, might not get filled exactly at 750, but our intent is to try to get filled there, then we would want to get out. Okay. Now, again, we're building this together. This is not a tried and true system, the best thing since sliced bread. We don't even know if it's anything about sliced bread, right? Or anything better than that. Okay. We are just going to test it out. Now, let's go ahead. We're going to put this in our bucket. And let's see if this will work it a little bit better. I'm going to put it in this bucket that says index options linear regression, meaning that's the investing plan that we used for it. Okay. I'm seeing a note out here that said something about a survey, but I didn't see a survey placed out here. These were comments from the last survey. If that survey is truly out there, I'll ask Barb to post it again for us so that we can see that. Okay. And then we'll make reference to it. Okay. In our remaining time, hopefully we're going to get filled on this. If it doesn't fill before the market closes, I'm going to go adjust our price, maybe even before our class is over, but I'm hoping that it will fill. All right. There we go. Just got filled on it. Perfect. And we're just going to let it play out. We're just going to allow it to move. Our intent, if we are still in the trade next week, our intent is to close it out and just put on a new trade, whatever's relevant for that day. If my hope, although it doesn't, things don't always work out as you hope they will, my hope is that it hits 50% of that target. That would be the most ideal scenario for it to basically say, great, let's take 125 out of the market. Now, going back to our charts here, we're going to go to our new index option strategy. Okay, let me just review the rules there. We buy 14 days worth of time, just like we just did on this linear regression. Let me change charts here though. Let's come over here. Somebody had me correct what I had out here. I think that was, who was that read that or noticed that, put a note in? I forgot your name, even though it was sitting, Terry Waters. Terry noticed that I had this little sign backwards. On here, we're looking for, to qualify for an entry, it's got to be, the price has got to be above the 200, the 50, and the 20, all of those moving averages. The 200 probably is not going to be a big factor most of the time, but the 20, which is the blue line, the red line is a 50, then they're going to be a lot more relevant, a lot more making decisions, okay? We also want to incorporate this market forecast line, and we want to make sure the blue line is headed up. So we've had a few days here where that blue line has been heading up. And since the price in the last 2 days has been above those moving averages, theoretically today and yesterday, we could have put on trades. Okay. And again, we're going to get out early if we can get 50% of the max gain. So let me show you what's happened in the last 2 days. All right. Head on over here to the monitor tab with me. And I am showing over here on the account statement. I am just showing 2 days back so that it shows today and yesterday. Okay, yesterday we put on a trade because the blue line was headed up and the price was above all the moving averages. And so we put on a trade and we said 210 is what we brought in, and we put on an order. Take 50%. If we can get 50% of that, get us out of the trade. And maybe I want you to see kind of the time frames here a little bit better. So on the 21st, okay, this was Tuesday, it finally got to that 50% area. and we were able to buy it back for $1.10. So our net there was about $1. Okay. And what did we do? Well, just a few minutes after that, when I noticed and I could see, oh, we're out of that trade, let's go do it again. So at 13:17, which is basically 1:17 in the afternoon, we put on another trade. We brought in $1.60. And you know what? I am in the order history instead of the trade history. So let me collapse this. Very similar here. Okay, 210 or 220 is what we brought in. We did buy it back for 110. Okay, so $1.10 there actually instead of $1 is what I said. The next one we sold for 160, and that was about 1:17 in the afternoon. And then during that same hour, almost at 2 o'clock, right before the bell rung, look at that, 13:59:59. It took our order and it filled us, probably because there was a market order out there, and it went and filled us instead of at 80 cents, it gave it to us at better. It filled us at 50 cents. So we actually got to keep more of that. So what's that net there? That's a net of about 90 cents. Okay, so on here, we have a $90 gain, we have a 110 gain, so about $200 because we're only doing one contract at a time. So for a day's work, for something you're not terribly mini or micromanaging, not too bad. Today, what happened? Today, we looked to see if we had the signal. We did have the signal. It's above all the moving averages, and the blue line was headed up. So about 25 minutes after the market opened, we went on, put on a trade. We collected $1.90. We put in an order to buy it back when we could get 50% of that, which would be in the neighborhood of what, about 95 cents. That's what we put our order in, and it filled. How many minutes later? 8 minutes later, it filled us at our order, and it filled us at 40 cents instead of at basically 95 cents, which it was nice. It gave us a better fill. Is that realistic? Once in a while, first thing in the morning when prices are popping all over the place, sometimes you get some fills that are really generous to you, probably because it's getting matched up with a market order instead of a limit order. But don't count on it. Okay, don't count on the market always being so nice to you, even though you might see that in paper money. Okay, and that happened what? Just a few minutes after. Okay, then we said, great, we're going to go put on another trade. So what has happened here? We have put on a trade. We collected $2 on it, and it hasn't hit 50%. Okay, why hasn't it hit 50%? Well, because the index has not done a whole lot. Now I'm just going to kind of zoom in here for a little bit. This is where we hit our first exit. This is where I should say, where we put on our first trade, and we got that pretty quick move up here, and we're able to get out on this green candle. And then we went ahead, put that trade on, probably about this candle, the green candle here. And if you look and see where that crosshair is, throughout the day, I'm going to have to zoom this back up here. Let me put it on here. We're basically below that now. So wherever we put the spread on, it's gone down, and we really wanted it to go up. Market doesn't always do what we want, so it did not hit that 50% gain. And if we go back here to our working orders, we said we wanted to buy it back at 120. Right now it's worth 240. Okay, so it's gone against us a bit, but not a huge bit. Okay, so we're just gonna hopefully let theta decay away. We'd love for the market to go up for a bit. That would get us closer to our target more quickly. Okay, but we're just going to let it work. And if we are still in that trade by next week, we will close it out, whether we're down on it, whether we're not down on it. Okay, and our exit lines and entry rules, I should say, are listed over here. Okay, so at class time, if we're still in it, we're going to basically roll or close down the trade and put on a new one. Okay, is what we would do here. And then I know for those of you that are just kind of getting used to some rules, having two different strategies that we're trading can be a little confusing, can be a little overwhelming. Okay, this is a more advanced class. Typically, people are familiar with spreads, and what we're doing is just trying to create kind of a process that we can follow, that we can just be consistent with, that we can just follow the rules and execute. And if in either of these trades we get 50% of the max gain, so the credit we sold it for, anytime it gets down to 50%, we are happy to bank the trade. Okay. Hopefully by seeing what happened over the last couple of days gives you a flavor for sometimes this thing can melt really quickly for us, and sometimes maybe not, right? Today, the market was running hot a little bit early, and then by the afternoon, it started to pull back, and then I think we're actually down right now. SPX is down. All right, any questions on any of all of this that we've gone through today? If so, let us know right now. Let's see. There really isn't a survey in there. Okay. Rodney says, are we still using the probability cone to set strikes for each trade? I did. So when we're using the new index options here, what I did for those buy signals that we had, I went ahead, I came over to this graph, this chart that we're using. I went out to August 5th, and August 5th is right there. Okay, that's 14 days from today. And so initially, I think we sold like 72 something. And I'd have to go back and look and see what the latest one was that we sold. I was thinking it was 73. So yes, 7,300. Yes, we are using the probability of expiring cone to determine where we want to sell. We're hoping that we sell just a little bit outside of this probability cone, because that's where the index is not expected to be. And we don't want it to go there. Okay, so we're going to sell where we're not expecting it to be. Okay. Hopefully I scrolled down there enough for you. Maybe we need to get my head out of the way so you can take a little note there. Let's see, Chris had a question here. Trying to find your original question here. But basically, yeah, we're going out 14 days. And by the time we get together next week, we're planning to either be out and have created a new one, or if we're still in it, we're going to close it out in our class. Okay, that's going to be our exit rule. Whether we're ready to get out or not, whether we've got a big profit or a loss, the automatic is going to be come what may, we're going to be out. Okay. All right, quite a lot of detail that we had here in our session today. So just kind of to recap, we did an SPX trade based on the linear regression model, which was, oh, I went the wrong direction. This one, this chart here, we see that we're going to go bullish unless we have a real bearish signal. We don't have a real bearish signal, so we went on and put in a bullish trade. The trade that we usually do in this class, I did two of them a little bit earlier today. So one very first thing in the morning, and one shortly after that first one was bought back for 50% of the profits. And then we put on another one. Let's just go look and see here the strike prices. So the one earlier this morning at 8:04 is the 72.50, 72.70. And then later with the linear regression, it turned out to be the 7,300 and 72.80 strikes that we used. Different criteria, different deltas that we're going for in the linear regression model. All right, I hope you guys are subscribers to our Trader Talks channel, because it helps make finding our content a lot easier. And let's go back. Let's go back here. Is it there? Nope, it's not there. I'm trying to find, there we go. When you're a subscriber, you see our Trader Talks logo there. It shows that you're subscribed. And then you can find our content. Coming up next is going to be Stock Investing for Beginners. Scott Thompson's going to teach that class. but it allows you to drill in on our playlist. So if there's some content you wanted to see, say from our previous trading index options classes, you could go back there and find it by just going into our playlist here. All right. You guys have been fantastic today. Appreciate your comments, your questions. And I like that you're getting engaged with this new modeling and kind of system rules that we're generating together, and we're going to test them out together. Barb, thank you for your help in the chat. These guys kept you pretty busy. All right, so take just a little break, then join us at the top of the hour for Scott Thompson, Stock Investing for Beginners. We'll follow up on these trades and any other I do during the week next week. Bye-bye.